really about 15% of office buildings can really only be repurposed for multifamily or some other use outside of office.
Right.
So what's interesting in what I'm hearing and what I'm starting to see is, yes, the foreclosures are coming in, but there's going to be what I would say a proverbial kicking of the can down the road. What does that look like?
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Michael T. Fay is chairman of the U.S. Capital Markets Group Executive Committee. He's the managing director of Avison Young's Miami office, and he's also the global director for asset resolution team Affinity Group. He has brokered over $16 billion in transactions over the last 40 years. Michael, welcome to the show.
Thank you so much. It's great to be here today.
Absolutely. The pleasure is mine, Michael. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Started commercial real estate when I was 13 years old. Honestly, 13 was the time when I wanted to really think about real estate. It was a great way to watch it happen. And with some friends of ours, I started in commercial real estate when I was 20 years old. Actually, this month, July 2023, it's been 40 years. So I'm 40 years in the business right now. I reside in Miami, Florida, and a couple other places. It's really, it's been a great business. I was involved in a bank and some other really great entrepreneurial ventures. And commercial real estate just allows such a purview into so many businesses and things going on. So that's why I feel blessed to be here.
Yeah, my gosh, that's a heck of a career and a heck of a, I mean, I'm thinking just the amount of change that you went through from 83 to 03. Right? Like that was incredible. And then to see that then turn and then do it again for the next 20 years, that's a lot. That's a lot to compress here into a 15-minute podcast. And I'm sure we won't even begin to scratch the surface. Tell me, what are some things you know that you're working on right now that you said, hey, this is something I'm really excited about in the commercial real estate space?
So right now, just to go back to what you just said, in these 20-year segments, I think I've been through 9 different downturns, and that was from the RTC days in the 90s to the Russian ruble crisis to the war and the Great Recession of 08, and of course the pandemic, and today our great inflationary period. So we see these, and there's a couple more in between. I think today, what's exciting is that they're really a tale of many cities. And it depends on what part of the country. There's all sorts of opportunity that goes on in different product types, whether it's office, industrial, retail, multifamily, development deals. We do some of the largest sales of development sites, especially down here in South Florida. I'm working on the $1.2 billion sale for Genting, the Malaysian gaming company, which we exclusively represent. And we're in the middle of several offers on that, which we're locking in on right now. We have other larger development sites. We do work with the courts. We do work with the special servicers, which I'll get into in a moment, on the CMBS side. But, I would tell you each area of the United States has got its own opportunities and weaknesses. And I think the biggest weakness that we're seeing across the whole country, South Florida being the exception, is the office market. The office, the return to office, the amount of office buildings that are experiencing the distress, the higher vacancies. And right now, we're going to see one of the largest resets, I think, on office product that we've ever seen across the country. And this goes for all the major metropolitan markets to CBDs, as well as, even tertiary markets.
Major resets. What are some things that you're seeing when you say major reset? What comes to mind?
So major reset really is what is the office going to look like? What does office space look like for the next 2 years, 5 years, 10 years, 20 years? How are employees working? How are people coming back to the office? So a lot of the return to office, there's different companies have learned to work differently. A lot of groups have got a 3-day work week. A lot of groups are doing a full-time. You got to come back to work. Some groups and companies are having a specified amount of days and weeks and vice versa. So I think each company is going through that. What's bad and what has been very trying is the owners of these office buildings are experiencing these companies saying, we don't know what we want. So therefore, there's a large amount of uncertainty. How much space am I going to need? What does the amenities look like? What do employees want to come back to? Do they feel safe? Do they feel secure? Why should people come back? I mean, at Avison Young, our biggest thing is camaraderie, communication, collaboration, and partnership. And so we kind of drive off of those pieces of why we're back in the office and what we're doing in the office. But a lot of companies feel differently. So what in my opinion is, as we go through this thought process, you're now hitting on large vacancies. Look at New York. New York's probably sitting at a 32% vacancy rate. But that's not uncommon. There's a lot of other areas. You can go to Chicago, you can go to Houston, you can go to LA, you can go to all these other major markets are having resets, if you will. So that's the big reset. The second part of the reset is really, what are the lenders doing on these large office portfolios and or individual assets across the country? So when you sit there and have all these groups that are trying to figure out their loans, so we've got rising inflation and rising interest rates. Interest rates right now are at the top as we've seen. That has put a major downward pressure on a lot of these groups that have got, well, what do you call maturing loans? These are loans that are maturing during this period of time, which is really creating, again, more downward pressure. So we've got these two confluences coming in and really creating this downward pressure.
So what are lenders? Let's talk about that for a minute. What are lenders doing and what are borrowers doing that own office space? I mean, we haven't, and forgive me if I'm wrong, tell me if I'm wrong, rather, but I don't know that we've seen mass foreclosure in the office space yet. Is that the case? And
so you're asking great questions. So I'm going to break it down to basically, 2 or 3 areas. So what's happened is I run the asset resolution team for Avison Young. We've got 140 different people across the U.S. and the major market and tertiary markets, and we are all hyper focused on helping lenders. That's the special servicers, the banks, life insurance companies, and even mezzanine lenders work through any issues that they have during this time. And by the way, separating office for 1 second, it could be an issue on a shopping center, could be an issue on a mall, it could be an issue on these things. And by the way, it's also depends on what part of the market you're in. And when I say the market, the country. So we're seeing that. Under the scenario of the office buildings, I will tell you, there's been some really large major national banks. Those banks peeled back many, many borrowers after the 2008, 2009 crash. And they would have, call it 90,000 borrowers. They scaled it down to 10,000 borrowers. The other 80,000 borrowers went off to community banks. They went off to regional banks. So the large banks spread the risk. But what's happened is, to call it the 10,000 customers they kept were the large ones. Those were the 150, 250, 300, $400 million credit facilities. And there's an old saying, little kids, little problems, big kids, big problems. So we've got that big kid, big problem that's affecting a lot of the servicers and the banks. So when we think about the office buildings themselves, that's where the reset's coming in. So you've got maturity, and you got vacancy issues, and you've got return to work, and what does it look like? So I read a statistic, probably 6 months ago on the office buildings. Only about 15% of office buildings can really only be repurposed for multifamily or some other use outside of office.
right.
So what's interesting in what I'm hearing and what I'm starting to see is, yes, the foreclosures are coming in, but there's going to be what I would say a proverbial kicking of the can down the road. What does that look like? The kicking of the can is really saying, okay, we're going to extend your loan. We're going to reset the loan. We're going to do a lot of different things. And it depends. If you're a servicer, that looks a little different than if you're a bank. And so, you've got these different ways. So I think the resetting is, they're going to get creative and state, listen, the property was worth $100 million. The loan was $60 million. So now all of a sudden, the property's worth 60 million. So does the bank want it back? The bank may say, listen, borrower, put in 10 million, or let us work out a short sale effectively, bring in a new buyer that's going to put in 10 or 15 million, and we'll keep the loan at the 60 million. There's going to be a lot of creative ways. Now, the problem is banks handle it differently than servicers, because you've got bondholders on the servicer side, you got credit default swaps, you've got a lot of other, what I would say, pressure points in that, as opposed to a bank, which the bank's making decisions based on their capital and their earnings for the actual quarter.
No, that's a really, really interesting scenario that you're painting there. So 85% of office space will forever be office space, is what I'm hearing. You're saying we can only convert 15% of it. If they're kicking the can down the road, trying to get creative, trying to work out strategies, or even doing cash in refinances, I mean, how are borrowers doing that? Hey, come up with 10 or 15 million bucks for an office space, maybe that's vacant or is already underperforming. Like, get that 15 million bucks from where?
So I will not name names, but you can figure out the names. The names are all the big investment houses and investment groups that have got office product in their portfolios. They're either selling it at major discounts and getting out, or two, handing it back.
Right.
And they're giving it back. Now, what's interesting, those same groups are also creating new funds, okay, investment funds, to go back and buy distressed office at a reset number. And that's what's going to end up happening, because it's the only way to this. Look, when you think about offices, and I'm talking about Class A trophy assets, where you, and I don't care, use New York City just because everybody's picking on New York City today.
Right.
Somebody said it was called New Glut City, glut of office space. I read that in an article somewhere.
Right.
At any rate, with the imagination of having corporate tenants on long-term leases forever and very hard to move, and all of a sudden today it's changed. COVID changed that whole thing. So now these corporations, as I said, are working differently, and their employees are working differently. People are working differently. So therefore, that whole system and that whole business plan has really changed. So it's forcing a reset, which I keep saying, and it's forcing a different look. And the way to do that is to really get real with what the situation is and handle this. So, all these groups are handing properties back, but they're also figuring out new funds, distressed funds or opportunistic funds, to go back and say, how do we work on the reset and make this better?
Absolutely. I mean, it's the right time to buy. It just kind of seems like, I mean, obviously these large companies can pull this off, but
well, let me say one thing, which is really interesting. You will find, believe it or not, and I'm not sitting there saying it, but you will find in some major metropolitan cities in the CBD areas where you may say this office building will no longer be there. They're going to figure out either, and if they can't repurpose it, which is only about 15%, you may see these buildings getting torn down and then having a brand new build, where we are seeing this in Miami. Our land values in Miami are continuing to increase all the time. And, we're bordered by Biscayne Bay and the Everglades. So the amount of land, I mean, you can look, it doesn't matter if you're in Chicago, it doesn't matter if you're in New York, LA, it's really, land constraints that drive everything.
yeah, absolutely. Absolutely. But on the buy side of things, I mean, I was talking to somebody else here on the show recently, and they were saying, hey, we're buying office space in New York City as fast as we can possibly get our hands on it, simply because they're paying $300-400 a square foot. When he goes, dude, 3 years ago, we were paying $9. He goes,
or 1,100.
Right. And he goes, even if our plan is to buy it and sit on it, it's like, okay.
And that's where you get to, but look, you get to figure out today. So office buildings are very interesting. You have cost of capital, so you got the interest rate, and then you've got tenant improvements, and certainly tenant rep and leasing commissions. Those are all very, very big. The old adage is you'll make a decent return on owning an office building as you own it, but you make all your money on the sales side. And that's what it was for years, right? Because it's a capital intensive asset class.
Right.
It was also considered one of the safest asset classes for years. And then now, multifamily, it's paint, carpet, and thank you very much. And, I can raise rents all year long as leases roll. So that's why multifamily continues to still be an asset class. Now, other asset classes, just to back into that, industrial, when you think about the pandemic pressing forward the use of internet retail sales, it went from that, call it 7 to 8% to 15% in a period of 2 years. That was almost like 10 to 12 years of growth compounded into only 2 years. And when you think of the logistics that's gone on and the distribution centers and everything else that happens, that's why, you look at great companies like Prologis and these other larger groups and these larger industrial groups that continue to build and service the retailers from not only that standpoint, but also the last mile logistics, which is really becoming interesting. Right. So industrial continues to be good.
It absolutely does. Yeah, it's very, very, very interesting to watch kind of how all of these interplay and see which ones are really doing well and which ones are struggling or plateauing. And again, I've heard it said since I got in real estate a decade ago, that real estate is local. I mean, I think I'm hearing that from you in the South Florida market. You guys are having.
It's local in a lot of ways, but when you start to look at industrial's more regionalized, if you will, only because of what you're handling. Right. Retail is local, but it depends also what you're doing. But when you look at the internet sales for certain retailers, and that experience becomes a whole different game and how that's played. So look, I think good neighborhood retail, anchored retail is good. The malls, we're handling several malls right now. We're having a couple foreclosure malls. We're handling some malls like the Broward Mall here in Fort Lauderdale for Rialto. It's an incredible mall, and it's got such an unbelievable upside of development and a replay there. So, we're in the middle of doing that. And we're going to have a call for offers here in the next, call it probably right after Labor Day weekend. But my point being is this is the retransformation of malls and creating what I would say urban centers, if you will, that will have residential, redone retail, destination entertainment, things of that nature.
Yeah, those are cool projects to see come around. I mean, in malls, my gosh, the amount of land those take up and the redevelopment front there, it sounds like that's an awesome opportunity. I know I looked at a project here recently. I think it was in Cincinnati. Similar idea. I mean, just an enormous undertaking, and it was
absolutely
all the redevelopment of an existing mall. What are some other opportunities you really see right now? I mean, you get to see things from a lot of different angles, but when looking at the commercial real estate landscape kind of across the country, what's something you see that is, you say, hey, there's excellent opportunity in what?
I still think, if you're looking at real estate, you can look at a lot of these REITs, some of the REITs in the public sector and the stocks. I think you could follow some of those groups and probably get some interesting buys from that standpoint as this reset is taking place on whether it's an office REIT or industrial REIT or a retail REIT, whatever they may, or even a multifamily REIT. I think you'll start to see some of those play. So if you're not buying real estate, you can participate from that standpoint. I think also, the crowd source funding continues to be, some people are doing that, but again, you've got to be careful with the sponsors. You've got to work with the right sponsors. You've got to watch what's going on to see how they handle their assets and what they do. Commercial real estate really for years and years and years, it was capital intensive. You needed to have a large slug of equity. You needed to be able to acquire loans. So right now, the opportunity, I think, is going to be watching the interest rates as for the next 2 years and the fallout. Remember, stock market goes down the fastest, it comes back the fastest. Real estate goes down really slow, and it takes a while for it to come back. So right now, we're on the downward slope in a lot of these areas, and I think we might have some decent foreclosures or short sales or motivated sellers. One of the interesting components here that I think we're seeing for the first time in a long time was interest rates were for the last, call it since the Great Depression, the Great Recession in 2008, 9, 10, interest rates were low. So you couldn't really go to alternative investments. It was either stocks or real estate, right?
Right.
Now you're seeing banks paying 5%, 6%. Look at the treasuries. There's alternative investments that you can go into and get that, call it 4.5% to 6% without much management. So the interesting part is people maybe say, I'm done. I want to move into something else. So you'll see some other sales happening from that standpoint as well. So I think the alternative, because interest rates have gone up, it creates a different sliding economic opportunity on both sides for a sale or a buy.
It really does. It really does. Let's talk about inflation for just a minute. I mean, it's one of those things, you know, what's your thoughts around a diverse portfolio that is inflation protected inside of commercial real estate? What's a play you'd recommend?
Well, I think it's anything. I mean, a lot of people were kind of going back. For us, when we work with clients, if it's a retail center, right, and there's fixed bumps in that without CPI increases, you pretty much you're pretty much locked in. It is what it is. So as inflation goes up and your other things go up, the value of the asset is either going to stay the same or go down. So I think, looking for opportunities where there's CPI increases or tenants rolling over, you can have these resets. And by the way, that's going on in industrial right now. In a lot of these areas where they had all these leases rolling, but industrial, because it's become such a hot commodity, you can end up raising the rates that you're getting on your industrial space. And we've seen some increased unbelievable rates. Same thing with multifamily. Multifamily, because it rolls every year, you can kind of catch up your rents to what your expenses are on the inflation. So, I think, and there's several markets within the country that have seen that 10 to 25, 27%, multifamily rental rate increases over the last couple of years.
Right. Yeah. It sounds like to summarize, you'd say anything that you can reprice in a shorter time frame than other things would maybe be the
absolutely
there.
Absolutely. I mean, that was the problem with office buildings. Office buildings, they were locked in with certain fixed rates, and they weren't going anywhere. While it was safe, remember, high risk, high return, low risk, low return.
Right. Right. And it's funny because in that even those office spaces were locked in, it was almost, you thought it was lower risk, but now it looks like it was a higher risk in the end deal there.
Well, but when you have two black swan events of the pandemic and then the global inflation that we had, which was pressed on by other global logistics and things of that nature, you would have never thought that. I mean, and you can look at the different the different graphs of each country and where it stands and where it is. It's just interesting to see. I mean, it was totally a global pandemic, but it's been a global inflationary issue. So those are the two black swan events within effectively a 2-year period, which is really what's that downward pressure.
Absolutely. Absolutely. This has been great. Michael, thank you for taking the time to come on the show today. Certainly learned a lot from you. I'd love to get your current kind of state of the market insight. Loved hearing about office space and kind of where you see opportunity on that front. You guys are working on some absolutely very cool projects. And again, thank you so much for your time. If our listeners want to get in touch with you and or learn more about you and what you do, what is the best way to do that?
So please, you email me at michael.fay@avisonyoung.com, or I'm always available. My cell phone's 305-495-0003. That is service.
You are a bold man, sir. I don't know that I would put my phone out there if I were you, but thank you very much. For those of you listening, that's an incredibly generous offer from Michael to put both his email and his phone number out there to get in touch with him. Michael, thank you again for coming on the show today. This was an absolute blast.
My pleasure. It was great. Thank you. Great questions and a great time. Appreciate it. Have a great one.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.